So, quite a bullish picture coming through from Asia, up 1.4% on MSCI Asia Pacific. We're seeing some real strength in some of those Asian markets. US futures look fairly robust. European futures look even more robust. How long does this last then, Sebastian? Does this continue?
We think the answer is no, Anna. And the simple reason is that we have had a fantastic bonanza over the past 15 months, accelerating global growth and a sharp drop in the discount rate. So if you go to your discounted cash flow model and you say stronger growth, lower discount rate, that's just fantastic. But we think both factors are now in the process of reversing. We think the global growth cycle has peaked and growth will start to roll over the coming months. And at the same time, real bond yields, i.e. the discount rate for equities, are already at an all-time low at a time at which central banks are starting to withdraw monetary accommodation. So the playbook for the coming months, in our view, is weaker growth, a higher discount rate, and that basically means the key factors that have been driving the rally are now in the process of going out of the picture.
Good morning, Sebastian. You're turning more neutral in the market after a great run. But, where is this money going to go? And I put that in context of the fact that you think yields are going to go a bit higher, so you're not saying it's going to go out of equities and into bonds. If people are going to pull money out of equities, or at least those people who can be more active, I know you're turning more neutral as opposed to actively bearish, but those people who are absolute return funds, where are they going to put money into if they're pulling it out of European equities?
Well, there are two answers to this. First of all, there are pockets within the market that still look attractive. So if you've got a situation where growth momentum is still quite robust and is slowly going to weaken, and at the same time there's scope for bond yields to rise, that is a very attractive combination for financials. So we think financials are the last remaining attractive part of the market. And then the second answer is sometimes in the cycle, cash simply is the most attractive option. If you've brought forward a lot of the returns through this wonderful combination of strong growth and a low discount rate that we've just discussed, sometimes it's a good idea to stand on the sidelines and wait for asset prices to normalize. And we think over the coming months, this is one of these occasions.
Sebastian, what have we learned over the last few weeks when the markets were preoccupied by, yes, the Delta variant, but also thinking about the regulatory clampdown that we've seen in China? What have we learned about any read across from that Chinese regulatory clampdown into European stocks? It's easy to see it in things like, Prosus and its holdings of Tencent, for example. But from your perspective, taking a broader look across the European equity picture, what kind of read across is there when you think about the clampdown we're seeing in China?
Yeah, so I think there are three answers to that. The first thing we always need to ask is it going to impact growth momentum? Because growth momentum is such a powerful driver of the market. And so far from what we're seeing, what we're hearing from our Chinese economists, the answer is no. It's an industry-specific issue. Then the second question is it going to have some broad impact on European equities in a way that maybe it's an additional factor that will matter? And again, the answer is most likely no. Yes, clearly it has impacted strongly. It had a strong impact on the Chinese equity market, but it has really just had an influence on specific stocks with high China exposure. And then thirdly, if you specifically look at these China-exposed names, it obviously had a tremendous impact on luxury goods. Luxury goods have underperformed by 10%. It was one of our first underweights, a cyclical underweight we had put in place. But because you had such a sharp drop on the back of the regulatory activity, our macro-based models now point to no further downside for luxury. So we've neutralized that underweight because thanks to these regulatory actions, that underperformance we expected came about far more quickly than we had expected.